This is CC. It is March 6th. Welcome to the Orbit. We've got stocks higher this morning. We're looking at the SPX at about 51, just shy of 5110. So we've gotten back above that 5100 level. Yesterday was kind of an ugly day. You can see it. We're looking at the 2-day chart. We gapped lower about 0.5%. We got as low in the SPX more than 1% lower, and then we saw a bounce into the close, right? We hit about down towards that 50-50 level, just shy of hitting that level. And we got a rally into the close that carried over this morning, and we've got this gap higher of about 0.5%, a little bit more than 0.5%. That takes us about, if you look on that 1-week chart, see where we are on that gap lower. We're basically right back at that level of where we gapped lower to start yesterday morning. Then on the 1-month chart, you can see where we are. Now, speaking of the 1-month chart and the 3-month chart, we have been in this kind of channel. Very clearly defined channel. You can really see it there on that 3-month chart. Now, of course, the news in the market this morning is the Powell testimony in front of Congress. No new news there. The statement came out and the testimony started. It's basically the same story, which is probably not lowering rates anytime soon. Because of the risk of having to raise them again in the future if the inflation target is not met, and not raising rates anytime soon. And that's probably what the market was a little bit of a sigh of relief, and it's a little bit of a relief rally on that there was really no new news. And going to the expected move levels, let's go for today. We are looking at about 5130 to the upside and 5080, let's call it, to the downside. That is about almost a 0.5% expected move, which is actually a lot. And that shows the little spike in volatility we saw yesterday. You saw the VIX up higher yesterday, but where you really see it is in these 1, 2, 3-day expiries, where the expectation is for a little bit more volatility from day to day. And you really see it here on this 1-week chart, where we've had moves now higher in a straight line of almost 2%, down in a straight line of almost 2%. So these are much bigger moves than options we're pricing, and they're trying to adjust a little bit. Now, of course, everything could just stop on a dime and we could go sideways. But for now, you're seeing a little bit more of an expected move from day to day. And out to the end of the week, we've got still about almost 1% expected move out to the end of the week. And it's really interesting. You can see on that chart there where the range is. It's basically yesterday's low, and then you look at like the top of these candle wicks, and it's the prior highs from just 2 days ago. So that's what we're pricing to the end of the week, is this range we just saw in basically the last 24 hours. But that is an interesting range because it is about what we started the week at. It's not much less than what we started the week at, which was only about 1%. So that shows you that near-term volatility has popped a little bit. So from a premium selling perspective, you've got some recently tested levels. Yesterday you saw this level down here. And, then obviously where we sold off from the other day. And as a premium seller, maybe these kinds of volume shelves up here, and obviously where this found buyers yesterday, those are some pretty obvious levels if you're legging into stuff or if you're doing things over a multi-day time period. Looking at the iron condor into the end of the week using those strikes, we are looking at a short call around the 5150 level, a short put around the 5060 level. You could obviously take that lower level down a bit. I'm hitting just the individual strikes there to get it to 50. Let's do 50 as the short put on the downside and 5150 as the short call on the upside. You are risking about 300 to make 200. You can then take, let's say, you're worried about this week as a premium seller. You're worried about this week that upper strike being a little bit too tight, and you're thinking that this week plays out like several of the prior weeks where the market actually does make a new high. Then you come up a little bit and you say, all right, maybe it's the 50, 75, 51, 75, and that's right there. You're looking at a bullish leaning iron condor. And again, we do the iron condor every day because you could obviously look at these individual credit put spreads, credit call spreads as premium sellers. From the, we don't do this every day, but let's look at the debit side of things. A call spread into the end of the week, and we're looking at March 8th expiry. So this is, let's go 5150 and let's go 5100. So it's a 50 wide debit call spread, and you can see that it's risking about 2 to 3. Now, obviously, that's a lot of money in SPX. The SPY version of that trade would be a little bit less. But I just wanted to kind of show you that risk reward, and that break even is in SPX. It's around 5120. So you would need the market up about 0.25% before you hit your break even, and then you would basically be a short and strike at the prior highs. And this is you could look at Qs, you could look at SPY, and get the same sort of general sense. If you were hedging for till the end of the week for some reason, then you could do the exact same thing as a put spread down to yesterday's lows.